Besides work, there are a number of other sources of income that can help you reach financial independence. Let's have a look at some of those other sources now. Pensions. A pension is a pool of money that both the employer and employees contribute into, which is then invested with the goal of growing it over time. Employees collect money from this pension fund when they retire. The longer you work at the company and the more you pay into the pension, the higher the benefits you'll receive. A defined benefit pension sets out how much you'll receive each year when you retire. A defined contribution pension states how much the employer will contribute each year towards your pension. A defined contribution pension is more popular today since there's more certainty for the employer. However, there's more uncertainty for you in terms of how much you'll actually receive, making it more difficult when it comes to financial independence planning. Canada Pension Plan, CPP. When you work, on your paychecks, you will often see a deduction listed as CPP or QPP in Quebec, which is your Canada Pension Plan or Quebec Pension Plan contribution. Contributing to CPP or QPP makes you eligible to receive a pension from the government when you reach age 65. Currently, the maximum benefit payable at age 65 is about $14,500 per year, so it's not meant to be a full pension that Canadians can live off of. Rather, it's meant to be supplemental income. The benefits paid can change over time and are often increased to keep pace with the rate of inflation. Old Age Security, OAS. Old age security is available to those eligible at age 65, however, is subject to clawback, which means it can be taken back if your income is at or above a certain level. Guaranteed Annual Income Supplement. This is additional income available to pensioners who have little or no income other than OAS. Registered Retirement Savings Plan, RRSP. An RRSP is a plan you can invest into to help save for your retirement or financially independent years. Money contributed to an RRSP is tax deductible up to a certain amount, and money made from the investments in the RRSP is not taxable if the money stays in the RRSP. Money from the RRSP is taxed when the funds are taken out of the plan. The idea is for funds to be contributed during someone's working years when their tax rate is higher, and then taken out in later years when their tax rate is lower. You can take money out of an RRSP at any time, however, that money will be taxed as income. Sale of assets. At points in your life, you may either sell a home, property, or other significant assets in order to generate additional income. Inheretences. When people pass away, they often leave money and assets to loved ones, which get received as an inheritance. These amounts can be very difficult to plan for, though, especially since not only can the amount change if people live longer and require using more of it to pay for their expenses and care, but the timeline as far as when it will come to you is very unknown also. Even though planning for financial independence may seem further off than other more immediate financial goals like saving for an education or a home, if you want to be financially independent and secure, don't leave it too long to start your planning.